कम मत करो यार, क्यों? रुको। इसमें तो लव नहीं है। ठीक। What is to be okay? मतलब मुझे क्या करेगा? पता नहीं। आर्केड में जाएंगे फिर। आर्केड। आगे? आर्केड आर्केड। आर्केड? हाँ, गरुड़ा मॉल के आर्केड में है। आर्केड में? वहाँ पे भी क्या होता? यहाँ गए थे ना। हाँ हाँ ठीक है। तेरा आवाज आ रही है, माइक बंद करना पड़ेगा। यही रुको, करो। किराए होते तुम्हारे स्ट्रीम में सारा ये लगेगा आज ये क्या है? क्या है? रुको, माइक बंद कर लेना। अभी आ रहा है?
Can also be appointed as the company's managing director. Term of additional director. The person appointed as additional director shall hold office from the date of his appointment to the date of the ensuing annual general meeting or date on which annual general meeting to be held, whichever is later. What happens if the annual general meeting is not held on the due date? The additional director so appointed has to vacate the office if the general meeting was not held on the due date. Remuneration of independent director. It is essential that an independent director remains independent and hence remuneration is inconsistent with independence, barring certain conditions. An independent director shall not receive any stock option or remuneration except for attending meetings, reimbursement of expenses for participation in meetings, and may receive profits subject to the approval of shareholders. The sitting fee for independent directors shall not be less than the sitting fee payable to other directors. This was to ensure that there is there is no financial nexus between independent directors and the company. Equating the fee of independent directors and other directors will ensure that they do not feel they are at a disadvantage. What are the liabilities of independent director? Independent directors shall be held liable for acts of omission by a company which occurred with their knowledge, with their consent or connivance, or where they did not act diligently. This will ensure that the independent directors can work honestly and take decisions without the fear of being trapped in a false case. Removal and resignation of independent director. An independent director shall be replaced within a period of 180 days from the date of resignation or removal. The procedure is identical to removal of other directors referred to Section 168, resignation of directors, and Section 169, removal of directors by the board. If an independent director remains absent from any board meetings for 12 months period with or without the permission from the board or violates any of the provisions of section 167, it will be deemed that the seat of director is vacant. Demerger of a company. In contradiction to an amalgamation, a demerger is a manner of having of a business of a company through a code-driven process. Demergers involve the transfer of a business undertaking, which may include a unit or a division or a business activity taken as a whole by a company to another company typically as a going concern. The resultant company or the transferee company following a court sanctioned demerger scheme may be a new company that needs to be incorporated or a company which already has a legal existence. Companies generally opt for demerger so as to provide distinct focus on each of the business under the group. Moreover, one of the prime reasons for companies entering into the demerger process is that the parent company is unable to optimize the returns. Demerger also happens when the shareholders decide to unlock the value by demerging their core business into a separate entity. The demerger can take place in any of the following forms. Number one, a spin-off. It is the strategy wherein the company's division or undertaking is separated as an independent company. Once the undertakings are spun out, both the parent company and the resulting company act as a separate corporate entities. Generally, the spin-off strategy is adopted when the company wants to dispose of the non-core assets or feels that the potential of the business unit can be well explored when operating under the independent management structure and possibly attracting more outside investments. Wipro is Wipro Information Technology Division is the best example of a spin-off which got separated from its parent company long back in 1980s. Number two, a split up. A business strategy wherein a company is split up into one or more independent companies such that the parent company ceases to exist. Once the company is split into separate entities, the share of the parent company is exchanged for the shares in the new company and are distributed in the same proportion as held in the original company, depending on the situation. The company may go for a split up if the government mandates it. In order to curtail the monopoly practices, also, if the company has several businesses line and the management is not able to control all at the same time, may separate it to focus on the core business activity. What is a due diligence? Due diligence is an investigation, audit, or review performed to confirm facts or details of a matter under consideration. In the financial world, due diligence requires an examination of financial records before entering into a proposed transaction with another party. In case of an acquisition and merger, the new owners assumes all responsibility for the business, which includes all existing liabilities of the business, such as pending tax claims, liabilities due to non-compliance, product liability, and so on. If the business has been releasing toxic substances in the environment which are yet to be discovered or brought to public notice, the new owners will be liable for a failure of the old management to contain such toxic substances when the problems will be detected post-merger or acquisition and can pose very damaging consequences. This is a significant risk that acquirers or investors face. To identify and minimize these risks, a due diligence exercise is carried out once the term sheet has been executed. If after the due diligence serious non-compliance with applicable law is discovered, or if there is a possibility of significant liability due to pending litigations or proceedings by department, etc., the investor may decide to not go ahead with the transaction, or he may ask for a reduced price. However, more often the investors or acquirers ask for a specific indemnity, representations, and warranties. In case of product liability, environmental risk, and such other risks, the acquirers may ask the management to take insurance of appropriate amount to cover such liabilities. Due diligence can be of different types: legal due diligence, financial due diligence, environmental due diligence, labor due diligence, factory due diligence, technology due diligence, tax due diligence, and so on. Depending on the transactions, some of these types of due diligence may be carried out for a business in which the factories are very important assets. A factory due diligence may be necessary. For example, if anyone plans to invest in or acquire the arms of Maruti, which holds the factory in Manesar, that is troubled by labor unrest, a thorough labor due diligence will be must. Letter of intent and its functions. Letter of intent is a document declaring the preliminary commitment of one party to do business with another. The letter outlined the chief terms of a prospective deal, commonly used in major business transactions. Letter of intents are similar in content to term sheet. One major difference between the two, though, is that letter of intent are presented in letter formats, while term sheets are listicle in nature. Letter of intent is issued to achieve the same end as the team term sheet, laying down the basic commercial proposal, recording common understanding of parties on certain key issues, and usually providing for an exclusive negotiation for an advanced level of deal striking. Letter of intent is more often used in merger and acquisition transactions, while the term sheet is used in BC and PE deals. Just like a term sheet, most provisions for letter of intent are usually non-binding. A major difference between term sheet and letter of intent is their drafting style. A term sheet is usually in bullet points or a tablet format, while a letter of intent is always written in the narrative letter writing style with well-worded paragraphs. Function of letter of intent. Letter of intent serves the following purposes: to set up the general intent of the party, especially the initial commercial proposal; to set up the key points of a complex transaction; to create a documentary basis for soliciting finance, loan, investment; to provide safeguard in case the business deal collapses during negotiations. Some term sheet or letter of intent can specify a breakup fee to be payable by one party to the other if after negotiation they decide not to go ahead with the deal. Next, negotiations. Duties of company secretary. Company secretaries are building blocks of companies and they must carry their duties with reasonable care. In addition to the role as legal mentors, company secretary must ensure that all business processes comply with all legal requirements. Failure to comply may result in liability for wrongdoing and termination for dishonesty or violation of the company's legal rights. Duties as per Companies Act to initiate and carry out the incorporation procedure. For example, validation of documents and procedures used in registration, ensuring the sending of registration data and its distribution to the registrar, submission of complications for additional shares capital, monitoring data on share certificates allotment, keeping records of share warrant holders, comply with and submit annual returns, issuance of the obligations to obtain a certificate of commencement, managing statutory books, giving updates and notifications for general meetings to every members, signing and authenticating financial statements and reports, balance sheets and profit and loss statements. For non-bank financial companies, submission of resolutions to the registrar and preparation of minutes of all general and board meetings within 30 days. Duties as per Income Tax Act to verify and submit attested returns and forms, monitoring the authentication process and TDS, ensure appropriate TDS is deducted from staff salaries, ensure that TDS reports are properly maintained and TDS are properly submitted to the government, obtain government approvals complying with the regulatory process of industrial disputes, FEMA Act, State Insurance Act, Depository Act 1996, Foreign Exchange Management Act, monitoring and compliance with various legal laws such as labor laws, competition laws, environmental laws, etc. Other general duties of a company secretary, advisory body and board of directors in risk management, business policies and strategies, corporate social responsibilities, brand equity and image building, managing the company's intellectual property rights, ensure healthy communication between those involved, authorities and government. What is a share subscription agreement? A share subscription agreement is a legal document which contains the obligation for an investor to subscribing to the company's shares if certain conditions are fulfilled by the company. These conditions are called conditions precedents. Often the obligation on the investor is not very tightly worded. and they may have the opportunity to back out of the investment at the last moment. The agreement also imposes restrictions on the company so that it does not take any actions that are not in the ordinary course of its business. A share subscription agreement sets out the terms on which an investor agrees to buy shares from a private company. It is often used to formalize informal arrangements agreed between the parties in a term sheet. A share subscription agreement sets out the terms on which an investor agrees to buy shares from a private company. It is often used to formalize informal arrangements agreed between the parties in a term sheet. What does a subscription agreement cover? At a minimum, a share subscription agreement will identify the company issuing the shares, the investor subscribing for the shares, the number of shares to be issued, the class of shares to be issued, for example, ordinary shares, B class shares, etc., and the amount to be paid by the investor, called the subscription amount, and the time by which the amount is to be paid. Sometimes all of the subscription amount is required to be paid upfront. In other cases, the subscription agreement is required to be paid in tranches over time, and some of these payments may be subject to the company achieving certain goals. What is a shareholder agreement? A shareholder agreement outlines how a company is to be operated, the rights and obligations offered to the shareholders, and the relationship between the company and the shareholders. It is similar to a partnership agreement, which is an arrangement between the various partners in a business. The purpose of a shareholder agreement is to ensure that shareholders are protected and treated fairly, and it allows them to make decisions on the third parties who may become shareholders in the future. Although it is designed to protect all shareholders, a shareholder agreement is more important to minority shareholders since it outlines the majority shareholders obtained to protect minority shareholders against abuse and give them a voice when key decisions are made. What is included in a shareholder agreement? Number on parties, board of directors, meetings, result, shareholder information and meetings, share capital and shares amendment. What is a term sheet? Term sheet is a non-binding agreement that sets out the basic conditions for making an investment. It serves as a template for developing more detailed documents that are legally binding. Once an agreement has been reached between the parties concerned on the details set out in the term sheet, an agreement or contract will be drawn up that conforms to the details of the term sheet. All term sheets should include certain basic elements, such as information on the identity of the parties involved, valuation, and preferred payments. It also includes information on all the properties involved, the initial purchase price, including contingencies that may impact that price, a response time period, and any other information that is considered relevant. Important conditions to be keep in mind for a startup term sheet. Number one, non-binding valuation of companies, amount of investment, percentage stake, anti-dilutive provisions, clarifying voting rights, describe the liquidation preference, investor commitment. A term sheet used as part of a merger or attempted takeover will typically contain information about the initial offer of the purchase price and preferred method of payment, as well as the properties included in the transaction. It may also contain information about what, if anything, is excluded from the contract or anything that either or both parties may regard as requirements. In addition, the term sheet also outlines the in principle agreement of parties over material terms and conditions, which acts as a basis for preparation of definitive legal agreements such as share purchase agreement and shareholders agreement during a later stage of a transaction. Usually a term sheet levels a lot of rooms for negotiations at the time when the definitive agreement are drafted. Functions of term sheet. Term sheet serves the following purposes: to set out the general intent of the parties, especially the initial commercial proposal; to set out the key points of a complex transaction; to create a documentary basis for soliciting finance, loan, investment; to provide safeguard in case the business deal collapses during negotiations. Some term sheets or letter of intent can specify a breakup fee to be payable by one party to the other if, after negotiation, they decide not to go ahead with the deal. Negotiations. What is the amalgamation process? The terms of amalgamations are finalized by the board of directors of each company. The plan is prepared and submitted for approval. For instance, the High Court and SEBI must approve the shareholders of the new company when a plan is submitted. The new company officially becomes an entity and issues shares to shareholders of the transferor company. The transferor company is liquidated and all assets and liabilities are taken over by the transferee company. The difference between asset sale and share sale. An asset sale involves the purchase of some or all of the assets owned by a company. Examples of common assets which are sold include plant and equipment, land, buildings, machinery, stock, goodwill, contracts, records, and intellectual property. including domain names and trademarks. The transaction is between the company and the buyer of the business assets. The seller retains ownership of the company structure in a share sale. The buyer purchases shares in the company rather than just the assets. The buyer purchases the company as a separate legal entity. Typically, the company continues to remain its assets and liabilities. The transaction is between the company's shareholders and the buyer of the shares. All business assets remain with the company. It is the composition of the ownership of the company that changes. Manner of undertaking an asset sale and slump sale. An asset sale can be undertaken through a business transfer agreement. In the case of an asset sale, the BTS should be provide an outline of the type of sale, terms of the sale, details of assets and liabilities, and consideration payable for each asset and liability. BTS may be structured in two ways. First, as an agreement to sell, wherein the manner of sale of the business undertaking is laid down. The second, where the BTA itself cause the sale of business undertaking and payment of consideration, and in such cases BTA is nothing but a deed of conveyance itself. To reduce the stamp duty complications, as a deed of conveyance has much higher stamp duty implications than an agreement to sell, it is advisable to transfer an undertaking through an asset sale. A slump sale is typically effected through a business transfer agreement. A BTA is an agreement between a transferor and a transferee company to execute a slump sale wherein ownership of every asset and liability of one or more units transfers, sells, lease or assigns to another for a lump sum consideration. After the round of negotiation, a BTA is executed within 1 to 2 months after entering into the contract. BTA is advisable for certain businesses because primarily it helps to avail of tax and regulatory advantages, among other reasons. Such reasons could be relating to improved performance of business, post-integration operational synergies, and strategic investments. A BTM must mandatorily disclose the following in its clause among the other relevant clauses as deemed fit: schedule of assets, schedule of liabilities, detail of creditors, list of contacts, list of employees, lump sum consideration, detail of intellectual property, name of parties, address of parties, pending suits, requisite representations and warranties, closing date. Manner of undertaking share purchase. An acquisition of a share of a company may be undertaken through a share purchase agreement. A share purchase agreement typically Lists out the value of the shares, the terms and conditions of the acquisition, and the right of the acquirer and the acquiree. The valuation of shares in a share purchase agreement is usually done by a chartered accountant or a registered valuer. In the event of the acquirer is a foreign entity, additional compliance with the relevant foreign direct investment policies shall also have to be undertaken. How is the method of accomplishing business transfer chosen? The method of business transfer can be chosen on the basis of cost implications, on the basis of whether the restructuring is taking place with the same group, or on the basis of the structure of the target company you are acquiring. For example, if promoters of an existing business want to sell a vertical but they have not structured it into a separate entity, a business transfer could be the most appropriate route. If they want to purchase only selected assets, an asset transfer is best. If the vertical is already structured as another company, a share purchase will work. In situations where more than one method is possible, reducing stamp duty (GST) on sale of assets and capital gains tax are going to be the key motivations. The pros and cons of amalgamation. Amalgamation is a way to acquire cash resources, eliminate competition, save on taxes, or influence the economies of large-scale operations. Amalgamation may also increase shareholder value, reduce risk by diversification, improve managerial effectiveness, and help achieve company growth and financial gain. On the other hand, if too much competition is cut out, amalgamation may lead to a monopoly, which can be troublesome for consumers and the marketplace. It may also lead to the reduction of the new company's workforce, as some jobs are duplicated and therefore make some employees obsolete. It also increases debt by merging the two companies together. The new entity assumes the liabilities of both. In brief, pros can improve competitiveness, can reduce taxes, increases economies of scale, potential to increase shareholder value, diversifies the firm. Cons can concentrate too much power into a monopolistic firm, can lead to job losses, increase the firm's debt load. What is an amalgamation? Amalgamation or merger is a route of business transfer whereby the assets of two companies become vested in one company, which may or may not be one of the original two companies. Amalgamation typically happens between two or companies engage in the same line of business or those that share some similarity in operations. Companies may combine to diversify their activities or to expand their range of services. Consequently, the amalgamating companies lost their individual existence and their shareholders become the shareholders of the new or amalgamated company. Usually this happens as a part of internal restructuring where group companies are merged into the holding entity to reduce the administrative and compliance burden. The term amalgamation has generally fallen out of popular use in the United States, being replaced with the terms merger or consolidation, even when a new entity is formed, but it is still commonly used in countries such as India. Since two or more companies are merging together, an amalgamation results in the formation of a larger entity. The transferor company, the weaker company, is absorbed into the stronger transferring company, thus forming an entirely different company. This leads to a stronger and larger customer base and also means the newly formed entity has more assets. What is asset sale? As the name suggests, an asset sale is the itemized sale of assets of an undertaking in a bit by bit manner, where individual values are assigned to each asset. Since this route offers an itemized sale, the acquirer can choose the assets he wants to acquire and the existing liabilities he wants to take up. Companies usually opt for a set sale method so as to clean up their balance sheets, which are saddled with bad loans. With respect to Indian scenario, many cases have been witnessed, including Kingfisher case, whereby the company borrow loans from the banks and later on they don't pay it, which makes it as a non-performing assets. To recover those loans, banks often force the companies to sell their assets to repay their ballooning debt. An asset sale is completed only when the assets of a company are acquired by a buyer. The buyer may incorporate a new company or use an existing company to acquire selected assets, along with management and contracts. This means the seller that sold the assets remains ownership of the company and must pay all of the existing liabilities and debts before taking the net cash proceeds. An asset sale carries much less risk for a buyer since any liabilities disclosed or undisclosed, as well as any contingent expenses, for example, pending litigations or tax resettlement, a step back with the selling company. The due diligence can then focus on betting the fair market value of the assets being acquired as well as the quality of the contracts and employees being transferred over. With an asset sale, there is considerable changes during and after the transaction close that needs to be managed. At transaction close, the buyer must ensure that the acquiring company is able to continue doing business with the new assets. Employees have been laid off from the selling company and rehired by the acquiring one, and all supplier and customer contacts that are being assumed have been legally transferred. Major customers need to be approached to ensure they will consent to the transfer of their contract, or else the buyer risks having the contract renegotiated. Post transaction, the buyer must ensure revenue is invoiced by the acquiring company and payments go to the new company rather than continue being sent to and deposited by the selling company. Despite the additional integration, management buyers typically prefer an asset sale because they get to write up the assets for tax purposes and can also leave behind any liabilities or other potential skeletons that the selling company may have. All of this is part of the deal in a share sale. What is a share sale? In a share sale, buyer purchases shares in the company rather than just the assets. The buyer purchases the company, a separate legal entity. Typically, the company continues to remain its assets and liabilities. The transaction is between the company's shareholders and the buyer of the shares. All business assets remain with the company. It is the composition of the ownership of the company that changes. As share represented the complete underlying value of the asset and liabilities of the company. The acquisition of shares is the most common manner of acquiring a company. Here the acquirer is looking to secure the entity which houses the business as well as the setup. Usually, when the target has made a name for its in the market and has an established loyal customer base, acquirer will be looking to acquire the company as well as the business. In the sale of purchase of a business, a very important consideration is whether the buyer should purchase the shares of the company comprising the business or assets of the business directly from the company itself. What is slump sale? Slump sale means sale of assets of the company as mentioned in Regulation 32 of Insolvency and Bankruptcy Board of India. Liquidation Process Regulation 2016 as amended. A slump sale, unlike an asset sale, is the transfer of a business undertaking as a whole on an ongoing concern. Slump sale can be made through a business transfer agreement or through a scheme of agreement under Section 232 to 32 of Companies Act 2013. It must constitute a business unit or individual or division to be carried on without any interruption as per Section 219A of the Income Tax Act 1961. Section 242C of the RTA provides that lump sale is nothing but a transfer of one or more undertakings as a result of the sale for a lump sum consideration with no individual value being assigned to each asset and liability. Slum sale through a BTA is less time consuming and confusing than the scheme of agreement. However, it is still the less favored way for the companies when the stakes are higher. There are numerous factors that determine which method is better in what condition. Slum set of assets as mentioned in asset sale process. Memorandum would be on as each where is basis and no records basis, and the proposed sale does not entails transfer of title, except the title which the company has on the assets as on date of the transfer. For a lump sum sale consideration without assigning value to individual assets, that is, there is a presumption in case of a transfer of this nature that the business entity will continue its operation in the future and will not liquidate or be forced to discontinue operations due to any reason. Slump sale happens when acquirer want to acquire the whole setup as it is without acquiring the entity housing the business. In this case, the acquirer is not only interested in the assets but in the whole processing unit. The operations would carry on as usual without much disruptions but under the arm of the acquirer. The purpose of restructuring a business through a slump sale could be business growth, better profits, stamp duty only on immovable properties, low capital gain tax instead of ordinary tax on an asset sale, cost effective process, takes minimal time in procedure and execution, managed to affect a slum sale. Number one, business transfer agreement. Number two, a scheme of agreement. Executive directors. Executive directors will generally be appointed by means of an appointment agreement, and their qualifications and nomination will be deliberated at length before the appointment, unless it is a family business or a promoter-run company, in which case he will find that the family members belonging to the promoter family will be designated as executive directors. Executive directors can be designated as managing directors, full-time directors, or simply executive directors. In either case, they will fall within the definition of key managerial personnel, though whole-time directors will only be key managerial personnel if there is no managing director, and will also be covered within the definition of officer who is in default under Company Act 2013. They are the directors who work solely for the company or at best for the group. They are internal to the organization and dedicate their time entirely to the activities of the company. They can be aware of the strategic as well as the tactical objectives of the company and achievement of the objectives. They will generally not be directors on the board of entities external to the group. They are generally remunerated at a higher level than the non-executive directors, barring very exceptional cases. Special requirements for public companies for appointment of independent directors and women directors. The new Companies Act has imposed additional requirements with respect to appointment of independent directors and women directors on public companies, whether they are listed or not. All listed companies are required to appoint a special category of directors like independent directors, small shareholders directors, and women directors in the board. Some of these requirements even apply to unlisted public companies. If certain share capital, debt, or turnover thresholds are exceeded, independent director. All listed public companies must appoint independent directors, that is, those who are not related to the company, as per the SEBI listing obligations and disclosure requirements regulations. However, the portion of independent directors cannot fall below more than one third of the total directors for better transparency and good governance. Unlisted public companies must appoint at least two independent directors in the following circumstances: 1. If their paid-up share capital exceeds rupees 10 crores. Number 2. If their turnover exceeds rupees 100 crores. Number 3. If the aggregate of all the outstanding loans, debenture and deposits exceeds rupees 50 crores. Women directors. All listed companies and their other companies having a paid-up share capital of more than rupees 100 crores or turnover of more than 300 crores must appoint at least one woman director. Director appointed by minority shareholders. To have a fair representation of the minority shareholders in a listed company, a shareholder having shares whose nominal value is less than 20,000 rupees. The minority shareholders may elect one director. Notice of such election must be given by at least 1,000 small shareholders or one-tenth of the total number of small shareholders, whichever is lesser to the company. Terms of appointment of directors. Generally, a director is appointed in an annual general meeting and can hold the post till the next AGM. However, the article of the company can provide for appointment of permanent directors in the article of company. In case of public company or its subsidiaries, only one third of the directors can be appointed as the permanent directors. Rest of the directors must retire by rotation at the AGM of the company. An independent director can be appointed for a period of consecutive 5 years. Such directors can be reappointed after passing a special resolutions by the board for a period of another 5 years. After two consecutive terms, an independent director can be reappointed only after a gap of 3 years, provided that the person was not appointed or associated with the company during the 3 years.
Appointment of additional director as per Companies Act 2013. Additional directors are directors appointed between two annual general meetings as per under section 161(1) of the Companies Act 2013. They can be appointed if there is
Casual vacancy on the board, and the board of directors need to appoint a director in order to meet the minimum number of directors. Even a sole director can act for this purpose. Alternatively, if they want to induct someone on the board before the AGM, they can appoint him or her as an additional director. The basic requirements for this purpose are that the Articles of Association of the company must grant the directors this power, and the person to be appointed as additional directors should not have been someone who has failed to be appointed as a director at a general meeting. In other words, directors cannot use their power to bring on the board someone who the shareholders have clearly rejected. The additional director's office will come to an end at the next annual general meeting held after his appointment, and if the shareholders appoint him or her, they can continue on the board. However, acts done by them during this term in their capacity will be valid despite the fact that the shareholders might not reappoint them. All of the formalities for appointment of directors will have to be completed for the appointment of additional directors. Powers and obligations of additional director. Though appointed on a temporary basis, an additional director is vested with the same power of the normal director. The additional director must utilize his power in the best interest of the company and the shareholders. The additional director can also be appointed as the company's managing director. Term of additional director. The person appointed as additional director shall hold office from the date of his appointment to the date of the ensuing annual general meeting or date on which annual general meeting to be held, whichever is later. What happens if the annual general meeting is not held on the due date? The additional director so appointed has to vacate the office if the general meeting was not held on the due date. Appointment of alternate director as per Companies Act 2013. Alternate directors are appointed by the board as a replacement for a director who is going to be away from India for a period of 3 months and is not going to be able to attend board meetings for this reason. Given that the presence of a director is permissible by video conferencing for many items of business, this appointment might not be that badly needed, but in certain cases, stakeholders might want to hire a physical presence on the board, and therefore an alternate may be appointed for a nominee. An alternate director for an independent must also be independent. Further, the same person cannot be appointed as an alternate for two directors. The alternate director will hold office only up to the period that the original director is back in India. But while he is on the board, he is a director for all particular purposes and is entitled to all notices, etc., of the meeting together with the original director. All acts done by him in his capacity as a director will be violate the deeming provision of vacation of office as soon as the original director is back in India. can cause certain problems. For instance, if the board has appointed B as the alternate director in place of A to attend board meetings held at the company's registered office at Bangalore, B will vacate office as soon as A lands in Mumbai, even though he might take a flight the very next day to move out of India again to be away for further 3 months and never come to Bangalore. Also, the alternate cannot hold appointment beyond the appointment of the original. If the original director resigns or is removed, the alternate automatically vacates office too, unless appointed by the board as an additional director. How are chairman appointed? A chairman is not appointed but elected. In India, a chairman is generally elected from among the board members by the directors, and you do not find non-board members chairing the meeting. Even the Table F to the Companies Act 2013, which deals with the Articles of Association of a company limited by shares, states that the chairman will be elected by the board. Though this does not seem to be an express prohibition on a non-member chairing a board meeting, non-members cannot cast a vote, and therefore there is not much more meaning in having a non-director as a chairman. Alternatively, board can have a chairman who is one of the board members and a chairman emeritus, who is someone who probably used to be the chairman and has since retired, who will simply guide and direct the meeting without using a vote. The casting vote is a significant weapon in the hands of a chairman, and if it is given in the hands of a non-board member, it defeats the scheme of company law, which gives the power of management of the company in the hands of the board of directors. There is no specific agreement or contract for appointment as a chairman. If the article provides for a specific manner of appointment of a chairman, he must be appointed in that manner. However, the mode of appointment is usually by a resolution at a meeting of the board of directors. There are also no specific eligibility criteria for being appointed a chairman except that a majority of the directors need to be willing to accept him as a chairman. The chairman must not be interested in the matters being discussed at a meeting, and for those matters where he is interested, he would need to vacate the chair. A person who is also the managing director or CEO cannot also be appointed or reappointed as a chairman unless the articles provide for this, and the company is not engaged in multiple business except for a specific class of company which has been notified. If they have CEO for each, the chairman of the board will usually chair general meetings also. However, where the chairman is not present at the general meeting, the directors present can elect one among themselves to chair the meeting, and if none of the directors is present, the members can elect one among themselves to be the chairman. This, however, rarely happens, since unless there is a sudden requirement, the annual meetings are usually planned keeping the chairman's diary in mind. Not only this, the meetings are carefully planned in consultation with the chairman. appointment of independent directors as per Companies Act 2013. Independent directors are those directors who either have expertise or network or experience in a particular area. Many companies would choose ex-officials or a regulator to be an independent director since they are aware of the functioning of the regulator, and this can make the relationship of the company with such regulator fairly smooth. Independent regulators can also include women directors who are mandated by the law to have on board for all listed companies and other companies having capital and turnover above prescribed levels. They can bring a fresh perspective to an otherwise all male board. The more diverse thinking and attitude a board has, the more a project is likely to be analyzed from different angles, and sometimes a company might be able to find an opportunity which the existing board would otherwise not have thought of. Independent directors, by definition, cannot be paid a remuneration, and therefore independent usually either payment is in terms of sitting fee or the meetings they attend and or chair. There are some roles such as occupier under the Factories Act 1948 or the director signing the income tax return on behalf of the company, etc., which should ideally be handled by directors who are thoroughly involved with the day-to-day operations of the company and should therefore be performed by executive directors. Removal of chairman, where the chairman of the board has been appointed at a meeting of the board. He can also be removed by the board at its meetings. In the case of a general meetings, there may even be a poll demanded on the appointed of the chairman, which would then need to be moved forthwith. Members can also propose a motion of no confidence, which can be seconded by another member and if put to vote and passed by a majority. The chairman will be removed. However, the chairman will have a right of representation before it put to vote. Generally, the constitution document of the company will not name of a specific person to be the chairman. It may, however, provide that the chairman would be a nominee of a particular stakeholder, be it the holding company or the founder or the lead investor. If this happens, the board can remove the chairman and replace him only with the nominee of the stakeholder as provided in the articles. For obvious reasons of conflict of interest, the proposed chairman cannot participate in the discussions or voting related to his appointment, and the existing chairman cannot participate in the discussion or voting related to his removal. The resignation from directorship of the company would almost in all cases involve resignation from the chairmanship, except in case of the chairman emanates position. As already discussed, the chairman's position cannot sometimes become crucial on account of the power of the casting vote which has been granted to him, whereas specific stakeholders believe that such a power cannot be given in the hands of a certain person. They might request for an agenda item to remove the chairman, and if the majority of the directors present at the meeting and entitled to vote so decide, the chairman will be removed. The resignation of chairman. A chairman can resign from the chairmanship of a board or a committee by tendering a resignation letter addressed to the board of directors of the company. The board will thereafter appoint a new chairman. The board need not to pass a resolution to approve the resignation of the chairman. It is enough if it is noted in the minutes and the new chairman is appointed. Generally, the board would have a vice chairman in place to take the office when the original chairman resigns, or to be the chairman in the event the original chairman cannot attend the meeting. Role and responsibilities of chairman. The term chairman or chairperson have not defined in the Companies Act 2013. This may be for the simple reason that this position is not restricted to companies. Anyone who presides over and manages the conduct of a meeting can be said to be chairing it. It just assumes a tad higher importance in the company structure since most life decisions of companies are initiated at board meetings, where the chairman or the chairperson has a significant role to play. The board of directors, considered the board of the company, has to take collective decisions based on collective wisdom of all members. in order to get a sense of the direction where the collective wisdom leads and to address the issues of self-interest and conflict of interest of individual board members in decision making facilitator is required. This is the role a chairman will play. The prime role of a chairman is to preside over the meeting, lead in various discussions, move the meeting according to the agenda and maintain discipline in the meeting. The primary role of a chairperson is to ensure that the board of directors is effective in its principal goal, which is to set and implement the company's direction and strategy. Usually, the chairperson is appointed by the board itself and can either be a full-time or part-time role depending on the board's demands. Sometimes, usually in smaller companies, the role of the chairman is combined with a managing director or chief executive. Joint roles such as those are not recommended for public companies that are listed on the stock exchange. While chairperson, they are expected to act as the organization's leading representative. This involves the presentation of the company's aim and policies to potential clients or partners and to the outside world. They are expected to take the chair at both general meetings and board meetings. For board meetings, this involves determining the order of the agenda, ensuring the board receives accurate, timely, and clear information, keeping track of the contributions of individual directors, ensuring they are all equally involved in decision making. Regardless of the meeting type, the chairman should be directing discussion towards consensus views and agreements and should be summing up discussion so that everyone understands what has been agreed upon. They are expected to take a leading role in determining the composition and structure of the board. This means regularly reviewing the overall size of the board, the balance between executive and non-executive directors, as well as the balance of age, gender, experience, and personality. Finally, they are expected to ensure effective and constructive communication with shareholders and stakeholders.
हेलो फ्रेंड्स, आज हम बार काउंसिल ऑफ इंडिया के फॉरेन लॉयर्स एंड फॉरेन लॉ फर्म से संबंधित नी रूल के बारे में जानेंगे, जो कि 19 मार्च 2023 के बीसीआई के प्रेस रिलीज में बताया गया है। तो हम देखते हैं कि बीसीआई के इस प्रेस रिलीज में फॉरेन लॉयर्स एंड फॉरेन लॉ फर्म के बारे में क्या कहा गया है। Number 1, foreign lawyers and law firms shall be allowed to advise their clients about foreign law and international law only। मतलब फॉरेन लॉयर्स एंड फॉरेन लॉ फर्म्स अपने क्लाइंट को केवल फॉरेन लॉ एंड इंटरनेशनल लॉ से संबंधित एडवाइस ही दे सकते हैं। Number number two, they would render advisory work about such law for their foreign clients only. मतलब फॉरेन लॉयर्स एंड फॉरेन लॉ फर्म्स अपने फॉरेन क्लाइंट के केवल एडवाइजरी से संबंधित वर्क कर सकते हैं. नंबर थ्री, foreign lawyers and law firms shall be allowed to function in non-litigation areas only. मतलब फॉरेन लॉयर्स एंड फॉरेन लॉ फर्म्स केवल नॉन लिटिगेशन वर्क ही कर सकते हैं. नंबर फोर, foreign lawyers and law firms shall not be allowed to appear in any court, tribunal, board before any statutory and regulatory authority or any forms legally entitled to take evidence on oath or on and or having trapping of a court. मतलब foreign lawyers and foreign law firms किसी भी कोर्ट, ट्रिब्यूनल, बोर्ड, स्टैट्यूटरी और रेगुलेटरी अथॉरिटी और एनी फोरम जो एविडेंस ले सकता है में अपीयर नहीं हो सकता है. नंबर फाइव, entry of foreign lawyers would be on reciprocal basis only. That is, lawyers of only those countries would be permitted in India where Indian lawyers are also permitted to practice. Means जिस फॉरेन कंट्री में इंडियन लायर्स अपीयर हो सकते हैं, केवल उसी कंट्री के लायर्स इंडियन कोर्ट्स में अपीयर हो सकते हैं. नंबर सिक्स, foreign lawyers would be allowed to appear for their clients in international commercial arbitration only. Means foreign lawyers अपने क्लाइंट के लिए केवल इंटरनेशनल कमर्शियल आर्बिट्रेशन में अपीयर होने के लिए अलाउ किए जा सकते हैं. नंबर सेवन, the Supreme Court on 13th March 2018 in BCI versus AK Balaji and others had desired the BCI or Government of India to frame rules about entry and regulation of foreign lawyers and foreign law firms. Means 13 मार्च 2018 को सुप्रीम कोर्ट ने बीसीआई यानी बार काउंसिल ऑफ इंडिया वर्सेस बालाजी एंड अदर्स के मामले में बीसीआई बार काउंसिल ऑफ इंडिया एंड गवर्नमेंट ऑफ इंडिया से फॉरेन लॉयर्स एंड फॉरेन लॉ फर्म्स से संबंधित रूल बनाने को कहा था. Yet the direction of Supreme Courts were to be followed. BCI therefore stepped into bringing out these rules, allowing foreign lawyers entry in a very restricted sphere, which is not going to impact at all advocates practicing in India. Means इसलिए बीसीआई ने फॉरेन लॉयर्स एंड फॉरेन लॉ फर्म्स को रेस्ट्रिक्ट करने के लिए और इंडियन एडवोकेट्स के इंटरेस्ट को प्रोटेक्ट करने के लिए ये सारे रूल्स बनाए हैं। 9. It is to be noted that this rule should not be misconstrued to allow any non-lawyer or any BPO, etc., any agent to come to India and start practicing in any sphere and or under any trading style, if in teeth and substance it amounts to practice of law as held in A.K. Balaji and others. Moreover, reciprocity is the very essence of the rule, which may be kept in mind. Sri Mohanto Sen, Secretary, Bar Council of India. So that's all for this video. Thank you so much for watching this video. Please do like this video and subscribe this channel. Thank you.
हेलो एवरीवन, वेलकम टू माय चैनल। कैसे हैं आप सब? आई होप आप सब अच्छे होंगे। आज के वीडियो में हम बात करने वाले हैं कि राहुल गांधी की संसद की सदस्यता कैसे खत्म। राहुल गांधी केरल के वायनाड से कांग्रेस के सीट से सांसद हैं। राहुल गांधी को गुजरात के एक कोर्ट द्वारा 2 साल की सजा दिया गया है। राहुल गांधी को सजा 2019 के मानहानि के केस में मिली है। 2019 के लोकसभा चुनाव के दौरान राहुल गांधी ने कर्नाटक के एक रैली में मोदी उपनाम से संबंधित अपने भाषण में एक विवादित बयान दिया था। इसी मामले में राहुल गांधी को गुजरात के एक अदालत द्वारा 2 साल की सजा सुनाया गया है। राहुल गांधी को सजा के तुरंत बाद अदालत द्वारा जमानत भी दे दिया गया है। अदालत ने राहुल गांधी को भारतीय दंड संहिता की धारा 499 और 500 499 आईपीसी एंड 500 आईपीसी के तहत सुनाया है। 15,000 के बेल बॉन्ड पर राहुल गांधी को जमानत दिया गया और राहुल गांधी को ऊपरी न्यायालय में जाने की अनुमति भी अदालत द्वारा दे दिया गया। सांसद या विधायक की सदस्यता समाप्ति के नियम, डिस्क्वालिफिकेशन ऑफ मेंबरशिप। भारतीय संविधान के अनुच्छेद 102 एक सांसद की अयोग्यता के बारे में बताता है। और भारतीय संविधान का अनुच्छेद 191 191 एक विधायक की अयोग्यता के बारे में बताता है। यदि कोई सांसद या विधायक कोई लाभ के पद पर हो तो उसकी सदस्यता जा सकती है। यदि कोई सांसद या विधायक किसी सक्षम न्यायालय द्वारा दिमागी तौर पर अस्वस्थ घोषित किया गया हो तब भी उसकी सदस्यता जा सकती है। यदि कोई सांसद या विधायक किसी अवैध तरीके से किसी दूसरे देश की नागरिकता प्राप्त करता है तो उसकी सदस्यता जा सकती है। यदि ये सभी कारक मौजूद हैं तो किसी सांसद या विधायक की सदस्यता समाप्त हो सकती है। संविधान की दक्षिण सूची यानी एंटी डिफेक्शन लॉ, दल बदल के आधार पर यदि कोई सांसद या विधायक आरोपी पाया जाता है तो उसकी संसद की सदस्यता या विधानसभा की सदस्यता को समाप्त किया जा सकता है। रिप्रेजेंटेशन ऑफ द पीपल्स एक्ट 1951, जन प्रतिनिधित्व अधिनियम 1951, राहुल गांधी की सदस्यता जन प्रतिनिधित्व अधिनियम 1951 के तहत ही गई है। So that's all for today's video. Thank you so much for watching this video. Please do like this video and subscribe this channel. Thank you. हेलो फ्रेंड्स, इस वीडियो में हम चिकित्सीय लापरवाही यानी मेडिकल नेग्लिजेंस के बारे में डिस्कस करने वाले हैं और देखेंगे कि मेडिकल नेग्लिजेंस के अंतर्गत किसको दोषी ठहराया जा सकता है और इसके लिए कानून में क्या प्रावधान है। तो चिकित्सीय लापरवाही एक चिकित्सा व्यवसायी द्वारा एक अधिनियम या चूक से उत्पन्न होता है जो किसी भी कारण से सक्षम और सावधान चिकित्सक ने नहीं किया होगा। कदाचार और लापरवाही एक विशेष प्रकार का व्यक्तिगत चोट का मामला है जो अस्पतालों, डॉक्टरों, नर्सों या अन्य चिकित्सा पेशेवरों के खिलाफ लाया जाता है। जो लोग एक चिकित्सा कदाचार की चोट से पीड़ित हैं, वे इस प्रकार के पेशेवर लापरवाही पर लागू होने वाले विशेष नियमों के तहत उस चोट के लिए जिम्मेदार चिकित्सा देखभाल प्रदाता को रखने में सक्षम हो सकते हैं। इंडियन मेडिकल एसोसिएशन में सुप्रीम कोर्ट के फैसले के बाद बीवी शांता ने उपभोक्ता संरक्षण अधिनियम 1986 में परिभाषित सेवा के दायरे में चिकित्सक पेशे को लाया। इसने रोगियों और चिकित्सा पेशेवरों के बीच संबंधों को अनुबंध के रूप में बदल दिया। जिन मरीजों को इलाज के दौरान चोटें लगी थी, वे अब मुआवजे के लिए प्रक्रिया मुक्त उपभोक्ता संरक्षण अदालतों में डॉक्टरों पर मुकदमा दायर कर सकते हैं। उपभोक्ता संरक्षण अधिनियम रोगियों के बचाव में नहीं आएगा यदि वे निःशुल्क प्रदान की जाती है या यदि उन्होंने केवल नाम मात्र पंजीकरण शुल्क का भुगतान किया है। हालांकि अगर भुगतान करने में असमर्थता के कारण मरीजों के शुल्क माफ कर दिए जाते हैं तो उन्हें उपभोक्ता माना जाता है और उपभोक्ता संरक्षण अधिनियम के तहत मुकदमा कर सकते हैं। रोगी को यह साबित करने के लिए कि डॉक्टर लापरवाही कर रहा था और यह चोट डॉक्टर की लापरवाही का नतीजा है। लापरवाही के ऐसे मामलों में गलत रक्त समूहों के रक्त का आदान शामिल हो सकता है, यानी रॉन्ग ब्लड ग्रुप ऑपरेशन के बाद रोगी के पेट में एक मोपला छोड़ना, असफल नसबंदी जिसके परिणामस्वरूप बच्चे का जन्म होता है, आदि। एक चिकित्सक को भारतीय दंड संहिता यानी आईपीसी की धारा 304 ए 304 ए के तहत लापरवाही से मौत के लिए दंडित किया जा सकता है। ऐसे मामले में कह सकते हैं जहां एक मरीज की मौत ऑपरेशन के दौरान ऑपरेशन के लिए योग्य नहीं है। आपराधिक लापरवाही के मामले में एक डॉक्टर के खिलाफ साबित होने के लिए आवश्यक लापरवाही का मानक विशेष रूप से आईपीसी की धारा 304 ए के तहत इतना अधिक होना चाहिए कि इसे घोर लापरवाही या लापरवाही के रूप में वर्णित किया जा सके। केवल आवश्यक की कमी नहीं, देखभाल यदि निर्णय या दुर्घटना में त्रुटि के कारण रोगी की मृत्यु हो जाती है तो आपराधिक दायित्व को आकर्षित नहीं किया जा सकता। एक डॉक्टर को आईपीसी के तहत चोट या शिकायत करने के लिए दंडित किया जा सकता है। हालांकि आईपीसी की धारा 87, 88, 89 और 92 में आपराधिक मामला चलाने से लेकर डॉक्टर के प्रति प्रतिरोधक क्षमता है, जो सद्भाव और रोगी के लिए कार्य करते हैं।